Welcome back to the Deep Dive, the show where we really try to unpack complex stories in science and finance. We want to give you the key knowledge you need, but, hopefully in a way that's more engaging than just reading a report. Today, we're tackling a really tough one. Karyopharm Therapeutics, Inc., ticker KPTI. If you're looking for a stock that just screams high-stakes biotech, this is probably it. You've got brilliant science meeting, well, some pretty brutal financial realities.
Yeah, it's definitely one of the most challenging deep dives we've structured. That tension is really the core of it all.
Right.
Karyopharm, on one side, has this genuinely groundbreaking cancer science. Their proprietary tech, it's called selective inhibitor of nuclear export, or Psi-Un technology. We'll get into the details, but it's fundamentally new. A real scientific breakthrough.
But then you flip the coin, and the business side, it looks like it's teetering. Staggering losses, a really precarious balance sheet, and the stock price, wow. It's been crushed, down over 90% from its peak back in 2020.
It's almost jarring, isn't it?
Yeah, it really is. How does that science live inside a company that seems to be fighting just to keep the lights on?
So that sets up our mission for today. We need to figure out for you. Is Karyopharm this amazing scientific value just waiting to be unlocked by a good clinical trial result? Is the market just totally missing the boat here?
Or is it the other thing? A cautionary tale. A company basically in a desperate race against its own patent clock, likely to run out of money before the science can bail it out.
That's the million-dollar question, or maybe billion-dollar given the potential outcomes here.
We've got to cut through all that noise, really look hard at the science, dissect the financials, and figure out what exactly is baked into that current stock price.
And, we can actually give a bit of a spoiler right now. We ran our valuation model, a risk-adjusted net present value model, RNPV it's called. Pretty standard for this kind of biotech.
And what did it show?
It showed something kind of remarkable. Karyopharm stock right now, it's priced in this very specific range. A potentially dangerous one, maybe. The current price, around $5.80, lands it smack dab in the middle of our estimated value range.
Dead center. So what does that actually mean for an investment?
It means investing here isn't like betting on a normal company, hoping management boosts sales a bit or trims costs. This is pure venture capital style speculation. It's like buying a lottery ticket.
A lottery ticket where the odds might be balanced by the payout.
Exactly. It boils down to an all-or-nothing coin toss on one single event, a binary outcome. If that one big experiment fails, the downside is, well, immediate and probably catastrophic for the stock price.
Okay, definitely a high-wire act. Let's start unpacking this. We need to get into the fundamentals first. We'll kick off with part one, the fundamentals.
Sounds good. Let's start at the beginning.
Chapter 1, business analysis.
All right, so Karyopharm. First things first, they're an innovation-driven company. They've actually made it to the commercial stage, which is a big hurdle in pharma.
They're selling a product.
Right, they're selling a product. But their main focus is still on these novel drugs targeting something called nuclear export. It's a pretty specialized area of cell biology.
And looking at their revenue, it tells a very concentrated story, doesn't it?
Oh, absolutely. About 98% of their revenue. It comes from direct sales of just one drug. Their lead drug, XPOVIO, that's the brand name for selinexor. And those sales are almost entirely in the U.S.
So incredibly dependent on one product, one market.
Massively dependent. The rest, that tiny little sliver, comes from the usual biotech stuff for international markets, license fees, milestone payments, royalties. They've got partners like Menarini in Europe and Tenjin in Asia-Pacific, Forest in Canada.
Which is standard practice, right? Lets them get global reach without building huge operations everywhere.
Exactly. It's strategically smart for a company their size. They collect checks on their IP without the massive overhead of selling everywhere themselves.
Okay, but let's get to the core of the potential upside, the science. We need to talk about XPOVIO, or selinexor. You said it's first in class?
Yeah, first in class. It's an oral drug, a selective inhibitor of nuclear export, a CII compound. Sounds complicated, I know.
A bit.
But the way it works, the mechanism of action, it's actually quite elegant and really interesting.
Okay, break it down for us. How does it fight cancer?
So you need to understand this protein called XPO1.
Yeah.
Think of XPO1 like a gatekeeper or a transport truck for the cell's nucleus. Its job is to shuttle molecules out of the nucleus into the main part of the cell, the cytoplasm.
Yeah.
Now, in many cancer cells, this XPO1 protein goes into hyperdrive. It becomes overactive. And crucially, it starts exporting proteins that are supposed to stay inside the nucleus to stop tumors from growing. These are called tumor suppressor proteins.
Ah, so the good guys get kicked out of where they need to be.
Precisely. They're exiled, they can't do their job inside the nucleus. Selinexor XPOVIO works by basically blocking that gatekeeper. It inhibits the XPO1 protein.
So it jams the exit door.
Kind of, yeah. It jams the exit. So those critical tumor suppressor proteins, they get trapped back inside the nucleus. They accumulate there. And once they're back inside in sufficient numbers, they can do what they're supposed to do. Trigger programmed cell death, apoptosis, specifically in the cancer cells.
Yes, yeah. That's a genuinely different approach than chemo or even a lot of targeted therapies.
It really is. It's targeting a fundamental cellular process that cancer cells often hijack.
And this mechanism, it's not just theoretical. It's led to actual FDA approvals.
Correct. They have approvals, but they're in very specific kind of late-stage situations, which impacts the commercial side.
Right. What are the current approvals?
Two main ones. First, for multiple myeloma, or XPOVIO, is used in combination with other drugs for patients whose cancer has come back or stopped responding, relapsed or refractory patients. Usually, these are folks who've already been through 4 or 5 other treatments.
They're pretty far down the treatment line. A later line therapy.
Exactly. A tough place to compete commercially. The second approval is for diffuse large B-cell lymphoma, DLBCL. That one's an accelerated approval, also for patients who've had at least 2 prior lines of therapy.
Accelerated approval. That always comes with an asterisk, doesn't it?
It certainly does. Accelerated approval means the FDA saw enough promise to let it on the market, but it's conditional. Karyopharm has to run more trials, confirmatory trials, to prove the drug offers continued benefit. If those trials fail, the FDA can pull that DLBCL indication right back.
So that's a kind of lingering risk hanging over them.
Absolutely. It's not the main headline risk, but it's there. A quiet drag on stability.
But the real buzz, the thing everyone betting on the company is focused on, isn't the current sales, it's the pipeline. This is where we get to the potential $1 billion catalyst.
That's it. That catalyst has a name. The Sentry trial. It's a phase 3 study, the big one. It's looking at selinexor for a different cancer, myelofibrosis, or MF. That's a rare type of bone marrow cancer.
And how are they testing it?
They're testing it in combination with a standard drug, ruxolitinib, specifically in patients who haven't had a JAK inhibitor before. And the key date everyone's watching. Top-line data is expected in March 2026.
March 2026. That date seems to define everything for this company right now.
It absolutely dictates their short-term life.
So why is myelofibrosis potentially so transformative? Why is this the trial that could change everything?
Well, a few reasons. The myelofibrosis market is considered pretty underserved compared to, say, late-line multiple myeloma. A win here would be a much cleaner commercial launch, potentially into an earlier line of therapy.
Okay.
Success in Sentry is seen as, well, potentially game-changing for Karyopharm. Some projections put the peak annual revenue potential up around $1 billion.
$1 billion compared to their current revenue.
Compared to their current $113 million or so in product revenue.
Yeah.
It's almost a tenfold increase. It would completely reshape the company.
What does success actually look like in a myelofibrosis trial? What are they measuring?
Typically in MF trials, you're looking at 2 main things. One is spleen volume reduction, or SVR. Patients often have enlarged spleens. The other is improvement in total symptom score, or TSS. MF causes a lot of debilitating symptoms like fatigue, night sweats, bone pain.
So shrinking the spleen and making patients feel significantly better.
That's the goal. If selinexor can show a significant improvement on those endpoints compared to the standard of care, the uptake from doctors could be pretty fast and dramatic. It could shift Karyopharm from being this niche struggling player to potentially a leader in a specific valuable cancer market.
Okay, but let's ground ourselves back in the present. You mentioned their market cap is tiny now, $55 to $95 million recently. That massive 90% plus drop from $1.15 billion back in 2020, that puts them in a really tough spot competitively, right?
Extremely tough. You've got $113 million in 2024 product revenue trying to make a dent in a global multiple myeloma market worth over $27 billion. It's David versus multiple Goliaths.
Who are the Goliaths in this space?
You're talking about giants like Takeda, Amgen, Johnson & Johnson. They have blockbuster drugs, Revlimid, Darzalex, Velcade, that are deeply entrenched, widely used, and have years of safety and efficacy data.
And XPOVIO is stuck in the later lines mostly.
Yeah, partly due to its side effect profile, which has
Yeah.
been a challenge, and partly just because the competition in earlier lines is so intense. It's really hard to gain significant market share when you're seen as a later option with some toxicity concerns.
So, given the weak financials we'll get to and this fierce competition,
Hmm.
what's their competitive advantage? What's the actual moat keeping them in the game?
The moat, the real value proposition, is that proprietary Acyan technology platform. They are the undisputed global leader in targeting XPO1. Nobody else has successfully brought an XPO1 inhibitor to market. That scientific leadership, that unique mechanism, that's their core asset.
And the legal shield for that science is crucial, the patents.
Absolutely crucial. They have strong intellectual property. The key ones are the composition of matter patents for selinexor itself.
Mm.
In the U.S., those provide market exclusivity until 2032.
2032. So they have a defined window.
A defined window. But here's the rub, the paradox. That moat is effectively narrow and time limited. It's all about selinexor, and that 2032 clock is ticking loudly. The company is in this incredibly high-stakes race.
They need Sentry to hit, and hit big, before 2032.
Precisely. They need to generate massive returns from a successful Sentry launch well before those patents expire and generics flood the market, destroying XPOVIO's revenue potential. If they can't build a profitable, sustainable business or a new pipeline by then, well, the company likely ceases to exist in its current form.
That really sets the stage for looking at the leadership team tasked with navigating this minefield. Let's move to Chapter 2, Management Evaluation.
Okay, leadership. The CEO is Richard Paulson. He came on board in May 2021. His background is interesting, over 25 years in big pharma, handling commercialization at places like Amgen, Pfizer, Ipsen.
That sounds like exactly the kind of experience you'd want for a company trying to successfully launch a major new drug indication like Sentry.
Theoretically, yes. He knows how to scale up sales, navigate regulatory bodies, deal with payers. That's invaluable if Sentry works. But the challenge is he's applying that big pharma skill set in a radically different environment.
Right, this isn't Amgen with deep pockets. This is a severely cash-constrained small biotech.
Exactly. So Paulson and his team, they have the right kind of commercial experience, but they're forced to operate with extreme capital discipline. They have to make these really tough, sometimes painful financial decisions that you just wouldn't see in a big pharma setting. Survival mode decisions.
And we saw a prime example of that crisis management back in October 2025 with that big financing deal.
That was a textbook survival move, pure pragmatism. They absolutely needed cash to bridge the gap to the Sentry data. They pulled together $100 million through this complex mix of debt, convertible notes, and straight equity.
Which sounds necessary, but also painful for existing shareholders.
Oh, incredibly painful. It was highly dilutive. They had to issue a lot of new shares and warrants, significantly increasing the share count to get that cash in the door. Existing shareholders saw their ownership percentage shrink.
But strategically, what did it achieve? It bought them time, right?
It bought them critical time. That $100 million successfully extended their cash runway into Q2 2026.
And Q2 2026 is crucially after the expected Sentry data readout in March 2026.
That's the whole point. They engineered just enough financial breathing room to reach the scientific catalyst. Management got credit for transparency during that process, and ultimately for pulling off a complex deal that staved off immediate bankruptcy fears.
Okay, so they survived the immediate crisis, but focusing purely on survival can sometimes mortgage the future. Are there criticisms of their longer-term strategy?
Yeah, that's a valid point. Some feedback from within the industry suggests that while they are absolutely laser-focused on executing the Sentry trial, which is job number one, there isn't a very clear, well-articulated plan for what comes after selinexor.
Pipeline replenishment.
Exactly. If the company wants to be sustainable beyond that 2032 patent cliff, they really need something new bubbling up in earlier stages, phase 1 or 2, ideally with a different mechanism or target. That early-stage innovation seems to have taken a backseat, likely due to the need to conserve every penny for Sentry.
It's a tough trade-off. Bet everything on the near-term win, or hedge your bets for the long term when you might not survive to see it.
It's the classic biotech dilemma, amplified by their financial situation.
Now, looking at how they allocate the capital they do have,
Yeah.
it's pretty straightforward, isn't it?
Completely. No dividends, obviously. No share buybacks. Every available dollar is going into internal R&D, primarily funding the big phase 3 trials. Sentry in myelofibrosis, and another one, EC042, in endometrial cancer.
And that history of dilution, especially the October 2025 deal, is just part of the Karyopharm story for investors.
It's baked into the cake at this point. Anyone looking at KPTI has to accept that dilution has happened and, depending on the Sentry outcome, could certainly happen again.
And when we look at the financial return on all this R&D spending so far, well, the numbers are pretty stark. Return on invested capital, ROIC.
Yeah, the ROIC is profoundly negative. We're talking figures that almost look like typos, ranging from around 1-12,285% to -1,634%.
Minus 1,600%.
Yeah. Now look, it's typical for pre-profitability biotechs to have negative ROIC. They're investing heavily upfront before revenues materialize. But numbers that negative really underscore the sheer scale of the investment they've made over the years without yet achieving sustainable profitability. It tells you how much ground they need to make up.
So bottom line on management and capital,
Yeah.
you can't value this based on efficient capital returns today. The entire investment thesis hinges on that future Sentry data, potentially generating an absolutely massive exponential return that justifies all this past spending and dilution.
It's a Hail Mary pass, financially speaking. They need that touchdown.
Okay, let's quantify just how fragile the current financial situation is. Chapter 3, Financial Analysis.
All right, the numbers. That current market cap, bouncing between $55 million and $95 million, is the market basically screaming loss of confidence after that huge fall from over $1 billion.
And the revenue picture isn't helping rebuild that confidence.
Not at all. Revenue trends are stagnant, even slightly negative. The 3-year revenue growth rate is actually negative 25.7%. And the full year 2024 revenue, $145.2 million, was essentially flat compared to the year before. They just haven't been able to meaningfully grow XPOVIO sales in its current approved indications.
Which feeds directly into the profitability problem or lack thereof, the margins.
Deeply, deeply negative. The operating margin is hovering around negative 83.9%. The net margin is even worse, around negative 90.0%.
Well, it's 90% net margin.
Yeah. It means their operating costs, the R&D spend for Sentry, the sales force for XPOVIO, administrative costs just completely dwarf the gross profit they make from selling the drug. There's a massive structural imbalance right now.
And that imbalance leads directly to the cash burn problem. Consistent, significant negative free cash flow.
Right. They're burning through cash every quarter just to keep the doors open and the trials running.
Let's tick through the financial stability red flags. Earnings.
Never been profitable. They keep posting substantial net losses. For 2024, it was a $76.4 million net loss.
That balance sheet helps.
Also a major red flag. We mentioned the liabilities, $343.08, far outweigh the assets, $104.09. This leads to that negative shareholder equity situation.
The stockholders' deficit, what was that number again?
A deficit of $238.9 million. That's a really critical indicator of financial distress. It basically means the company owes more than it owns. If they had to liquidate everything tomorrow, theoretically, after paying off all the debts, there would be nothing left for the shareholders.
Which explains why the stock trades almost like an option, rather than an ownership stake in a functioning business.
Precisely. The market is valuing the possibility of future success, not the current underlying assets or earnings power, because those are negative.
And the most immediate, critical red flag for liquidity, that current ratio.
Yeah, the current ratio is sitting at 0.99. That is right on the edge. A ratio below 1.0 means your current liabilities, debts, and bills due within the next year are greater than your current assets, cash, inventory, money owed to you.
So technically, they don't have enough liquid assets to cover their immediate obligations?
Technically, yes. It signals extreme difficulty in meeting short-term needs without bringing in new money or potentially delaying payments or cutting crucial spending. That October 2025 financing was a direct response to this impending liquidity crisis. They had to fix that ratio to survive.
Okay, so with financials like these, standard valuation tools like the price to earnings, PE ratio, are completely useless. It's negative.
Totally useless. So sometimes people look at price to sales, PS, for companies like this.
And what does Karyopharm's PS look like?
It's very low. It ranges from about 0.35x to 0.7x. For comparison, the average PS for biotech peers might be closer to 3.3x.
So on the surface, that looks incredibly cheap, right? Low PS usually signals value.
It looks cheap, but this is where you get the classic value trap. The market isn't stupid. That super low PS ratio is the market explicitly saying, We don't believe these current sales are valuable enough.
Why not?
Because those sales, that $145 million, aren't nearly enough to cover the massive R&D and operating costs required to fund the pipeline, specifically Sentry. The market is signaling that the real value, the only potential value, lies in the uncertain future success of that pipeline. The current business isn't sustainable on its own.
Which brings us back to needing a different valuation approach.
Yeah.
Not DCF, but the risk-adjusted net present value, RNPV, model. Explain again why RNPV is the right tool here.
Standard discounted cash flow, DCF, works best for stable, predictable businesses with positive earnings. Karyopharm is the polar opposite. RNPV is designed specifically for valuing assets with binary risk, like drug candidates in clinical trials.
How does it work mechanically?
You essentially treat each major drug program, like Sentry for myelofibrosis or the endometrial cancer trial, as its own mini project. You forecast the potential future cash flows if the drug is successful and gets approved. Big if.
Then you factor in the risk of failure.
Exactly. You apply a probability of success, POS factor. For a phase 3 oncology trial like Sentry, historical industry data suggests the chance of getting from phase 3 to FDA approval is somewhere around 58%. So you multiply those potential future cash flows by 0.58.
Okay, so you risk adjust the potential payoff.
Right. Then you take those risk-adjusted future cash flows and discount them back to today's value. But because this is such a high-risk venture risk of trial failure, risk of needing more cash, risk of dilution, you use a very high discount rate, much higher than for a stable company. We used a weighted average cost of capital, or WACC, in the range of 15% to 20%.
A high discount rate reflecting the high risk.
Precisely.
So you put all that together, potential cash flows, probability of success, high discount rate. What kind of value range did our educational RNPV models spit out for KPTI?
Our base case estimate landed in a range of $4 to $9 per share.
$4 to $9. And the stock is currently trading right in the middle of that at $5.80.
Exactly. But the key thing about the RNPV is its extreme sensitivity. It highlights the binary nature. If you assume Sentry is successful in the model, the value jumps way up, easily into the double digits, maybe $15, $20, or even higher depending on market assumptions.
And if you assume Sentry fails?
If Sentry fails, the model collapses. The intrinsic value plummets, likely well below $1 per share. Because without that potential blockbuster revenue stream, the underlying business just can't support the valuation.
That sensitivity really tells the whole story. Okay, before we see how the market is reacting to this high-wire act, just a quick reminder for everyone listening, don't forget to like and subscribe to Stock Analytics AI. For just €4.99 a month, you unlock our full library. That's 500 deep dive videos covering every single stock in the S&P 500. And coming up next, exclusively for our members, we're tackling the NASDAQ 100. Plus, members can request deep dives on specific stocks. Just drop the ticker in the comments, and we'll get on it for you. All right, let's get back to Karyopharm and see how the market is digesting all this risk and potential reward. We're moving into part 2, market, ownership, risk, and conclusion. Let's start with chapter 4. Market sentiment.
Okay, market sentiment. And what's striking here is this huge disconnect, this polarization. You've got two very different camps making very different bets.
On one side, you have the Wall Street analysts. What are they generally saying?
Overwhelmingly optimistic, actually. The consensus rating is typically a buy or moderate buy, and their average one-year price target, it's often way up there, around $18.
$18. That implies, what, over 200% upside from the current $5.80?
Easily. They are clearly looking past the current financial mess and betting heavily on the pipeline, specifically on Sentry success. Their models are essentially assuming a high probability of that $1 billion revenue stream materializing.
So the analysts are squarely in the bull camp, focused on the future potential.
Definitely. They see the risk, but they believe the potential reward massively outweighs it at this price level.
But then you have another group in the market sending a completely opposite signal. These short sellers.
Oh, yeah. The short interest in KPTI is extremely high. It fluctuates, but it's often been in the range of 9% or 10%, sometimes spiking up to 28.5% or even higher of the available shares, the float.
28%. That's a massive bet against the company.
It's a huge commitment of capital betting that the stock price is going down. These aren't casual bets. Shorting is expensive, especially for a stock like this with high borrow fees. It shows deep conviction from the bears that either the science will fail or the company will run out of money or face more crippling dilution.
And that high short interest creates its own dynamic, right? The days to cover metric.
Exactly. The days to cover has also been high, often ranging from 7 to 13 days. That tells you how many days of average trading volume it would take for all the short sellers to buy back the shares they borrowed to close out their positions.
7 to 13 days is a long time in market terms.
It is, and it means if there's any unexpected good news, maybe positive interim data, or even just a rumor, those short sellers could face a major squeeze. They'd all rush to buy back shares at the same time to limit their losses.
Creating a short squeeze, where the buying pressure from shorts covering drives the price up rapidly, even on minimal news.
Precisely. It adds another layer of potential volatility to the upside.
Now, amidst this bull-bear battle, the technical chart recently flashed a potentially significant signal, the golden cross.
That's right. Relatively recently, the stock's 50-day moving average crossed above its 200-day moving average. For technical analysts, a golden cross is often seen as a bullish indicator, potentially signaling a shift from a downtrend to an uptrend, or at least increasing positive momentum.
But how do you reconcile a bullish technical signal like that with the fundamental picture we just painted, the 0.99 current ratio, the massive deficit? It seems contradictory.
It does on the surface, but I think you have to connect the technicals back to that key fundamental event, the October 2025 financing.
The timing makes sense.
Before that financing deal, the bear case was clearer, maybe even inevitable. The company was projected to run out of cash before the March 2026 Century data. Bankruptcy seemed like a real possibility.
So the shorts had a clear runway.
They had a clear time-based thesis,
Right.
but that $100 million financing, however dilutive, fundamentally changed the immediate narrative. It removed the imminent threat of bankruptcy. It pushed the cash runway past the Century readout date.
So the market had to reevaluate.
Exactly. With the immediate bankruptcy risk off the table, the market's focus shifted entirely back to the binary outcome of the Century trial in 2026. The Golden Cross likely reflects that renewed focus on the potential upside catalyst now that the most pressing short-term financial danger was averted. It's not necessarily a signal of improving profitability today. It's a signal that the core scientific gamble is back in play.
That's a fascinating interplay between financial engineering and technical market signals. Okay, let's look at who's actually holding the stock. Who is making these bets? Chapter 5. Ownership structure.
The ownership structure is quite interesting, too. Institutional ownership is pretty high, typically around 50% or sometimes more. You see big, well-known names on the list.
Like who?
Major players like T. Rowe Price, the Vanguard Group, BlackRock. These are sophisticated institutions managing huge amounts of money.
But are they all on the same page? Looking at recent filings, their actions seem completely divergent.
That's the key point here. There's profound disagreement even among the big institutions. Take T. Rowe Price, for example. They're known for doing deep, fundamental research, especially in complex areas like biotech.
And what did they do recently?
They significantly increased their position in Karyopharm. One filing showed something like a 421% increase in their holdings. That's a strong signal of conviction. They're clearly buying into the science, the ion platform, and the potential Century payoff, seeing the low price as an opportunity.
The huge vote of confidence from a respected manager. But then you look at Vanguard.
Right. In a similar time frame, filings showed the Vanguard Group made a massive reduction in their Karyopharm holdings, something like a nearly 95% decrease towards the end of 2025. That's a colossal amount of selling pressure coming from one source.
So how do we interpret that? One major institution loading up, another dumping almost everything.
You have to be careful not to read them the same way. T. Rowe Price's buying likely reflects active management conviction. They've done their homework and believe the stock is undervalued based on the science. Vanguard's massive selling, however, might be what's called forced selling. Vanguard runs enormous index funds. When Karyopharm's market cap collapsed so dramatically, the stock probably fell out of certain indices that Vanguard's funds are required to track.
Ah, so if it's no longer in the index, they have to sell it, regardless of whether they think the science is good or bad.
Exactly. It's mechanical selling driven by index rules, not necessarily a fundamental bearish view on the company's prospects from Vanguard's analysts. So while it creates selling pressure, it doesn't carry the same informational weight as T. Rowe's active buying decision.
That's a really important distinction. What about insiders? The executives, the directors, the people who presumably know the most?
Insider ownership is actually quite high, around 6.29%. And if you look at recent transactions, there have been net positive acquisitions lately, including by the CEO, Richard Paulson.
Okay, insiders buying is usually seen as a good sign.
It generally is. But again, we need to add some nuance. The vast majority of these recent acquisitions by insiders are listed as acquisition, non-open market, and often show a price of $0.
Meaning their stock grants or options awarded as part of their compensation package.
Precisely. It's incentive compensation designed to align their interests with shareholders, which is positive. But it's not the same powerful signal as an insider taking their own personal money and voluntarily buying shares on the open market at the current $5.80 price. That kind of open market purchase shows much stronger personal conviction.
So alignment, yes, but maybe not overwhelming personal financial bets from insiders recently, outside of compensation.
That seems to be the picture, yes.
Okay, we've looked at the business, the management, the finances, the market sentiment, the ownership. Let's try to synthesize all of this into a clear risk assessment. Chapter 6, Risk Assessment.
Right, let's pull it all together using that classic SWOT framework: strengths, weaknesses, opportunities, threats. It really highlights the core conflict here.
Okay, let's recap. What are the fundamental strengths Karyopharm has?
Strength number 1 is the novel, proven science and the XPO1 platform leadership. Strength 2 is the existing commercial revenue from XPOVIO, however troubled. And strength 3 is that defined patent moat providing exclusivity until 2032. That's their core scientific and legal foundation.
And the weaknesses, the things dragging the stock down.
Weakness 1,
Yeah.
the severe financial distress, that 0.99 current ratio, the negative equity, the ongoing cash burn. Weakness 2, the acute dependency on just XPOVIO right now. And weakness 3, that history of significant shareholder dilution.
Now, the opportunities. What's the potential upside that keeps the bulls interested?
Opportunity number 1, the big one, is Sentry trial success in myelofibrosis, March 2026. That's potentially transformative. Opportunity 2 is maybe expanding selinexor into earlier lines of therapy if they can manage toxicity better or future data supports it. And opportunity 3 is always acquisition potential. A larger pharma company might swoop in to buy the Sign platform, especially if Sentry looks promising.
And finally, the threats, the things that could destroy the investment.
Threat number 1 is the flip side of the opportunity. Clinical trial failure for Sentry. That's the existential threat. Threat number 2 is the intense, ongoing competition from pharma giants with vastly greater resources. And threat number 3 is the near certainty of future dilution if Sentry fails, and they need to raise more cash just to survive past Q2 2026.
Wow. Yeah, the SWOT analysis really lays bare that tightrope walk. The biggest opportunity and the biggest threat are essentially the same event viewed from different sides.
Absolutely. It's all riding on that one clinical outcome. But we also need to consider factors outside the company. The macroeconomic environment isn't helping them either.
Right. High inflation, high interest rates. How does that specifically impact a company like Karyopharm?
It hits them hard in a couple of ways. First, higher interest rates make borrowing money much more expensive, assuming they could even access debt markets given their balance sheet. It also makes raising equity capital harder and more dilutive.
Because investors become more risk-averse in high-rate environments.
Exactly. Money flows away from speculative, pre-profitability biotechs like KPTI towards safer assets. So if they needed to sell more stock, they'd likely have to do it at a lower price, causing even more dilution.
And inflation.
Inflation directly increases their costs. Running clinical trials gets more expensive site fees, patient recruitment, lab work, manufacturing costs go up, general operating expenses rise. This just accelerates their cash burn rate, making that runway they bought themselves even shorter. The macro environment actively works against companies burning cash.
And there's another potential external risk, more geopolitical. The talk of potential U.S. tariffs on imported pharmaceuticals. Could that affect Karyopharm?
It definitely could. Like many smaller biotechs, Karyopharm relies on third-party contract manufacturing organizations, CMOs, and many of those facilities or the raw materials they use, like the active pharmaceutical ingredients, APIs, come from overseas.
So tariffs, potentially high ones like 100% or 200% is sometimes discussed, would hit their supply chain.
Directly. It would increase their cost of goods sold, or COGS. Given their already deeply negative margins, they have absolutely zero room to absorb higher input costs.
It would just make the financial losses even worse.
Immediately worse. Plus, a small, cash-strapped company like Karyopharm simply can't afford the massive investment and logistical complexity required to suddenly shift all its manufacturing to potentially higher-cost domestic facilities just to avoid tariffs. It's another external pressure point on their already fragile finances.
Okay, we've covered a huge amount of ground here. The science, the precarious finances, the management strategy, the market battle, ownership, external risks. Let's try to bring this all together into a final conclusion. Chapter 7, Conclusion.
All right, let's synthesize. We've seen this deep polarization throughout the analysis, the bull case. It hinges entirely on the genuinely novel S-sign science and the massive $1 billion potential upside if the Century trial hits in March 2026.
And the bear case.
The bear case rests squarely on that extreme financial fragility. The negative equity, the near 1.0 current ratio, the cash burn, coupled with the inherently high risk of failure for any phase 3 drug trial.
And our valuation work suggested the market is actually pricing this conflict quite accurately right now.
Yes. Our educational R&PV model gave us that intrinsic value range of roughly $4 to $9 per share.
And with the stock trading at $5.80, it's sitting right in the middle of that risk-adjusted range.
Which tells us the market is likely being efficient in financial terms. The current price seems to reflect a balance. It's incorporating both the substantial upside potential if Century succeeds and the very real, very severe downside risk if it fails. It's not necessarily cheap or expensive, it's priced for the binary risk.
So what's the final provocative takeaway for you, the listener, grappling with this incredibly complex situation?
I think the key takeaway is this. An investment in Karyopharm Therapeutics today is not like investing in most other companies. It's not a bet on management incrementally improving a stable business. It is a highly concentrated, almost pure speculation on a single binary scientific event.
You're essentially acting like a venture capitalist.
Exactly. You're placing a bet on the outcome of an experiment scheduled for March 2026. You're betting on the potential of the drug discovery, not on the current financial health or operational efficiency of the business itself. It's an investment in the science, acknowledging that if the science fails, the current business likely cannot sustain itself.
A stark but clear assessment. This has been a truly fascinating, if challenging, deep dive into the absolute knife-edge reality of biotech investing. Thanks for navigating us through all that complexity.
My pleasure. It's definitely a case study worth understanding, regardless of whether one invests.
And thank you all for joining us on the deep dive. Remember, if you want us to tackle other specific stocks, especially complex ones like Karyopharm, members can drop tickers in the comments section of our videos, and we'll add them to our list. Our next big project is covering the NASDAQ 100 exclusively for members. And finally, as always, please keep this important disclaimer in mind. This analysis was generated by an AI system for educational purposes only. It should not be considered financial advice. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. We'll see you on the next deep dive.